Greetings from FinstudyClub. My name is Ankur Kulshrestha, welcoming all viewers to the fourth part of the session that we had started with the indirect method and its conversion into the direct method. Now, before looking at this session, it is absolutely imperative that we look at the other three parts, wherein we first talked about the focus on CFO, then we talked about focus on CFF and CFI, and in the just preceding session we talked about the net versus gross book values of the long-lived assets, and this particular session is the fourth in the series of conversion of indirect method into the direct method. Of course, even before looking at this fundamental, it is imperative to look at what is a direct method, what is an indirect method, and the overview of cash flow statement. So really I am at the fag end of cash flow statement and almost like wrapping it up with this concept. Let's try and understand what are we trying to say. We are basically trying to say is that in an indirect method, one of the most important critical point is the PAT, which is the starting point. You would remember that PAT had to undergo four different adjustments: non-cash, non-operating, tax adjustments, and working capital adjustment in order to become CFO. The key question here is, unless and until we have the PAT, how would we implement those four assumptions? So the point to be noted is, if income statement is given, I can obviously very quickly look at PAT. But if your income statement is not given, how would you even start my indirect method? So this entire video, the star that I had put in, is only and only to calculate the starting point of the CFO, which is calculated indirectly. So now in order to look at these things in detail, it is very imperative to look at the procedure in a straightforward, or should I say the correct manner, because ultimately we would be going backwards. What I'm trying to say is, we have already taken the journey forward from PAT, wherein this is the output of the income statement, to the retained earnings, which finally goes into the balance sheet. This we have already done while we would have made the income statement. Now the key question is, this is what I'm trying to say, your PAT would have come from income statement, and from which you would have deducted the dividends, A to preference shareholders and B to common dividends, which is common equity, and then is your the net change, the delta, which is added to the opening retained earnings to make it closing retained earnings. So short point I'm driving home is, you've already done this. The key point is, just start in the reverse direction, because now what we are trying to say, that you are given a balance sheet, you are given the ledger accounts, let's say retained earnings X and Y, the opening and the closing amounts. How would you calculate your P&L account from this? So the way I'm going to start is, just move backwards. I can always find out the change as closing minus opening, which in this case is y minus x. Obviously I'm going to take a lot of examples. Let's try and understand with the help of xy. Now this delta is here. This is the final delta that has happened, and you would see that the difference between this PAT and this delta is the dividends. Therefore, I am going to add any dividend which has been proposed during the year. So effectively what I'm trying to say is, this delta has been transferred to the balance sheet as part of retained earnings. I am going to just move backwards. So this PAT became delta and then got transferred. The only thing I'm going to do is, from the balance sheet I'm going to calculate delta, and from which I'm going to calculate PAT. Just start moving in the opposite direction. So it says net change in the retained earnings, which was my last step, plus, rather than deducting, now obviously the sign will change. You will add any dividend proposed, whether to preference or to equity. I can also write a similar, very very similar equation in another manner, which says the opening retained earnings, whatever you had in the opening balance sheet, if you add the PAT earned minus the dividend proposed, which effectively is your delta, is equal to the closing retained earnings. So obviously, it's like the stating the same thing in different words. So before looking at a full length example, I want to highlight a couple of important points. The first is that the retained earnings may appear with different names as per different accounting standards. Now you would look at IFRS, you look at India GAAP, you look at US GAAP, get J GAAP, which is Japanese GAAP. There are different accounting standards and each follow a different, should I say, nomenclature. So some people say it has reserves and surplus. Some people will say that profit and loss account. Some people call it retained earnings, some call it profit and loss appropriation account, some call it comprehensive income, from where we can, if remove OCI, then we get the cumulative balance of P&L, which is your retained earnings. So point is, in the balance sheet, if income statement is not given in the balance sheet, find out and look for these nomenclatures. The second point I wanted to highlight is that if you look the journey straightforward, it starts with PAT and ends at a further stage. The quick question that I'm kind of throwing is, sales has become PAT, which has become change in retained earnings. I want to ask students as to the profit before tax and provision for tax are part of one or are part of two. Actually, they are part of one, which means your tax provision has got nothing to do with the P&L appropriation account, should I call it, or should I call it the distribution of the profit. They are actually the charge on profit. Hence, this charge on profit should be forming part of stage 1. Here is stage 2, which is after calculation of part. Therefore, my summary point that the provision of tax does not appear after PAT. Therefore, I have excluded it from the discussion up front. Because obviously, I am moving from here to here. It's like I don't get that in my way. It's almost like saying, let's say from New York, there is London, and here is Japan. So if I'm going to go from New York to London, I'm going to find, let's say, a particular city. The key question is, from Japan I am going to London. Will I find that city? Obviously no. Will that city has any role to play? Obviously no. So that's pretty much my point number 2. And my point number 3, also very critical, is I want you to take a note of the word that I have used: dividend proposed, not paid. Dividend proposed, not paid. Point I'm driving home is, all that is your accrual based. Accrual based as in, like the income statement, importance is given to happening of things rather than cash flows. I agree with you that ultimate objective of calculating PAT is to arrive at CFO, but currently, you are not in a statement which is prepared as per cash. This statement is always prepared as per accrual. Therefore, I would like to request everyone to please be very careful about the dividend paid versus dividend proposed. Now, obviously, we are going to talk about, these in practical examples, but here is a very, very small, portion that I have got for you, which says that the proposed dividend, which is almost like provision for dividend, is something different than dividend paid. And the reason for that is, there is the time gap between dividend payment and proposal. I want to illustrate that. Let's say this is 2013. The dividend for 2013 can be calculated only at the end of the year when actual profit calculation is done. Now, obviously, you would imagine that it is not possible for any company to calculate the profit on the last day as well as distribute it to the dividend shareholders, on the same day. More so when this is a shareholders approval is required. So company in the next year will conduct an AGM in which the amount for which a provision has been created will be ratified, and finally it will be paid. So point I'm driving home is, if you look at 2014, it already have an opening balance which has been paid during the year, and the dividend for 2014, again the same story, will be arrived at only at the end of 2014. It will be only provided for right now, and if I extend this, it will somehow, the provision will be paid in 2015. So therefore, there's always like a year's gap. So if I were to highlight this point with example which I have taken, I am taking, let's say, 2011. There was already a balance of 100,000 and the closing balance is 150. So point is, this opening portion must be paid during the year and closing must be provided for. I have a very simple question to ask. How much is the dividend paid during 2011? It is out of the opening portion. But how much is the dividend provided for? For which year are we talking about? We are talking about 2011. So the provision will always be made for the current year, but the payment happens with a lag. So there is a time gap in payment, but the provision happens as per accrual. So the short point here I'm driving is, your opening will be assumed to be paid and the closing will assume to be provided. Point to be noted is, here I'm going to write dividend proposed. Here I'm going to write dividend proposed. Paid has got nothing to do with it. Of course, in cash flow from financing, my dividend paid is a cash flow and therefore it will appear under this head. In this case, 100,000 should have been paid. It says that the dividend unpaid is 70. That means till date 30 has been paid and 70 is still appearing. Okay, so dividend paid versus proposed is also an important point, and here is what I am at to calculate my PAT. The first example, it says your profit and loss account, the net balance has changed by 40,000. So if you look at 100,000 minus 60,000, so it says 40,000 is the net change, and the question is, the provision for taxation will not play a role. The dividend proposed from 0, it has become 200,000. That means during the year, for fiscal year 14, you would have proposed a dividend of 200,000. So therefore, your total profit after tax would have been 240. Now let's look at what would have happened in a straightforward manner. Your profit after tax, after being reduced by proposed dividend, this would have been the delta, which would have been added to the opening retained earnings to make it 100,000 in the balance sheet. I can also write the second equation as your opening balance 60,000 plus PAT 240 minus dividend proposed is equal to the closing balance. I could have also written it in this form. So the focus here was to arrive at the opening value of PAT when it is not given. So ideally I wanted P&L or income statement, but I was given excerpts of the balance sheet and I have been able to calculate my PAT from here. Now moving on to the next example, wherein we have a additional factor, presence of other reserves. Now you would understand by doing balance sheet that one is your basic retained earnings, which is almost like the main vault where the profits are kept. But sometimes you have different things like general reserve, you have some capital reserve, you have some capital redemption reserves. All these are smaller pockets which the firm creates for a particular purpose. with an exception of general reserve, because this is really the other name of retained earnings. So all I'm again saying is the nomenclature is a little different, but looking at the capital reserve and capital redemption reserve, these two are reserves created for specific purpose. Now, the question is, the amount in these are also transferred by P&L appropriation account, which is to say that the journey between PAT and the change in the retained earnings along with proposed dividend, you also have transfer to reserves. Now let's see how in this light we take these things up. Now again, the question is on calculation of PAT, wherein we have to see the starting point, which is the net delta, net change, which is closing minus opening, which is look at that carefully, 60 minus 50, my apologies, 50 minus 60. So that's the error that I also kind of got into. To be very careful with that, closing is 50, opening is 60, therefore net delta is negative. In that, you got to add the proposed dividend during the year, which means 2013. So my assumption stays that 1 lakh must be paid, must be for the previous year, and 2 lakh must be the one which has been proposed for the current year. So I am adding that back. And then, like I said, if during the P&L appropriation account some money has been deducted by transferring it to the reserve, I got to add that back, because I am actually making a reverse P&L appropriation account. So here it seems that capital reserve from 0 to 50,000 has been transferred from P&L appropriation account, and as a result of which I am going to add that back. So the story would have been that 250, the PAT would have been 240, out of which 250 would have been transferred. So we would have started by 240. The total deduction from the PAT must have been 250. Therefore, the net delta was minus 10. What we need to also kind of look at, now this question is an additional point here. So the answer to the first part is 2,40,000. Let's talk about the second part here, which says the capital gain on sale of investment is transferred to capital reserve. Now this is very critical. Like I said, that there are specific reserves to which the amount is transferred from P&L appropriation account. In this case, I had added back. However, if there is another reason for the same, for example, sale of investment, which is written, which has funded this reserve, that means P&L appropriation did not transfer any amount from its bucket to this capital reserve, as a result of which I will not add it back. So therefore, if I consider point number 2 is equal to net change of minus 10 plus proposed dividend, and you have no other factor in play, so your answer should be 190. Now again, I'm saying let's look at the concept in detail. I'm saying if something has been deducted, only then while coming back you can add here. Now here in the second part, the question is very clear that the amount hasn't been transferred from the P&L. Actually, there has been a sale of investment, and rather than amount going to P&L account, it has directly been transferred to reserves. So for me, a short point is that reserves have been funded not by P&L appropriation account, as a result of which I will not add it back. So in that case, my answer will be 1,90,000. If the reserves were funded from P&L appropriation, I will add that back, and in that case, my answer will be 2,40,000. Again, the key point here is that share capital anyways is has been repaid, has been bought back, has been a treasury stock, I don't know, one of the three. So therefore it will be shown as financing item, minus 200,000, and provision for taxation is anyways, is not going to impact the calculation of PAT indirectly. Let us talk about the third example, where we will focus upon the calculation of the retained earnings. The opening balance was 200,000, and during the year the profit earned has been 3,50,000. Now, dividend proposed and paid are two different figures. Now, the objective of this question is to clarify as to whenever we are going to talk about the retained earnings, I will not consider dividend paid. I will always consider dividend proposed. Of course, if it is just written dividend paid, then I will assume that this must be equal to proposed. If it is just written dividend proposed and no other figure is written, then I will assume that it is equal to paid. But in presence of both the information, that's a choice making, and there you will not take paid, you will always prefer the proposed part. So you have the opening balance of 200,000 plus the profit after tax. Ideally this entire amount should have gone, however this was reduced by the dividend that you have proposed, so the delta retained earnings is 2,50,000, which makes it equal to 4,50,000 as the retained earnings in the closing balance sheet. So I hope that these examples have been fruitful in building a base. Should you have any question, any query, or you want us to take a specific topic ahead of the schedule, we'd be very happy to review your request at finstudyclub@gmail.com. This was Ankur Kulshrestha from FinstudyClub. Thank you very much. I look forward to speak to you in my forthcoming sessions.